Hello, and welcome to Fed Tax 101. In this episode, we're going to discuss the economic performance rules. As we discussed in a prior episode, if you're using an accrual method of accounting, understanding the economic performance rules is a key step in making sure you correctly compute your tax liability by accounting for income and expenses on the correct year's tax return. If you haven't watched the Fed Tax 101 episode on the accrual method, you may want to check that one out first. Today's episode will make a lot more sense if you do. As a refresher, recall that under an accrual method of accounting, you can deduct an expense in the tax year in which that expense meets the two-pronged all events test and economic performance occurs. The two-pronged all events test is satisfied when all of the facts have occurred that establish your fixed obligation for that expense and you can reasonably estimate its amount. Before the economic performance rules came along in 1984, an increasing number of state and federal regulations, especially in the environmental protection area, combined with improvements in the ability to estimate the cost of large-scale projects many years in advance, created a situation in which the all events test was allowing companies to claim deductions on this year's tax return for huge costs that would not actually be paid for many years, in some cases for decades. Because of the time value of money, this was a real boon for companies and a source of real concern for the government. Let's take a look at one of the cases that brought this problem to a head for the government. The year is 1981. Under the environmental laws of the state of Ohio, companies engaged in strip mining had a statutory obligation to reverse the environmental impact caused by its mining activities. In some cases, the mining activities would last for many years, resulting in the mining company having a fixed legal obligation today for something it would not have to actually do for many years. Both the IRS and the taxpayer agreed that it was possible to reasonably estimate the cost that the company would spend on land reclamation once the mine eventually closed. So that meant the second prong of the all events test was already satisfied. The IRS argued, though, that the taxpayer should not be allowed to deduct this enormous amount until it started incurring out-of-pocket costs by actually refilling and grading the soil, planting new trees, and so forth. The taxpayer argued that under the all events test, it didn't matter when it actually spent money satisfying its obligation. That only matters for cash method taxpayers. Instead, all that mattered was that as of the end of the tax year, it had a fixed obligation under state law to perform land reclamation activities and that the amount it would spend on those activities in the future could be determined with reasonable accuracy. The taxpayer argued that those are the only requirements for deducting something on this year's return under the all events test. The tax court agreed with the taxpayer. Because each of the two prongs of the all events test was satisfied, it didn't matter how far in the future the taxpayer would actually start writing checks to satisfy an obligation for which it was already legally liable. Because it was using an accrual method of accounting rather than the cash method, the taxpayer could deduct those estimated costs this year. State and federal environmental laws imposed similar obligations upon oil and gas companies, nuclear power plant owners, and other industries where significant environmental remediation might be required decades in the future. You also have fixed legal obligations imposed for things like workers' compensation, judgments or settlement agreements for tort liabilities, and any number of other things. So, all of these various state and federal laws imposing an immediate liability for things that wouldn't happen for a potentially long time, coupled with advances in estimating those future costs, created a real problem for the government in applying the all events test. The economic performance rules were added to the tax code in 1984 in an effort to plug this hole. Essentially, the economic performance rules say that an accrual method taxpayer needs more than just a fixed legal obligation in order to deduct something. You also need to have some sort of change in your current economic position. you need to have immediate skin in the game. The specific type of economic change in your position depends upon the type of liability you're talking about. The tax code basically creates four categories of liabilities: those where something is being provided to the taxpayer, those where something is being provided by the taxpayer, workers' compensation and tort liabilities, and other liabilities described in the tax regulations. If your liability arises from your obligation to pay for goods or services that you are going to receive, then economic performance occurs as you receive the goods or services. For example, if I sign a contract to buy a piece of equipment, economic performance for the amount I have agreed to pay for the equipment only occurs when the seller provides me with the equipment, not when I sign the binding contract. If I'm contracting for someone to paint my house, economic performance for whatever I've agreed to pay the house painter occurs only as my house is actually painted. Along those same lines, if you've signed a contract to use someone else's property, economic performance only occurs as you use the property. So, for example, if you've agreed to pay someone 5 cents a copy for use of their copy machine, economic performance for your annual photocopy expenses occurs a nickel at a time, even if you sign the contract in December and can reasonably estimate how many copies you expect to make the next year. You cannot deduct those costs until the next year when you actually make those copies. On the other hand, if the liability arises from your obligation to provide goods or services to someone else, in other words, your own expenses in providing goods or services to your buyer, economic performance only occurs as you actually provide the services or goods to your buyer. So you would not be able to take your costs into account until you actually start performing under the contract. If you sign a contract in December, agreeing to paint a customer's house in January, you can't deduct your estimated costs of materials and labor until you actually start painting the house the next year, even if that amount is reasonably determinable based upon your prior experience painting similar houses. Keep in mind, though, that because the economic performance rules only apply to deductions, you might have to treat the contract price as income in the year in which you sign the contract, even if the economic performance rules prevent you from deducting your related expenses until the next year. That's one of those situations where you don't have a perfect match between an item of income and the related expenses of producing that income. We talked about that in our first episode on the clear reflection of income. The tax code also says that if you have an obligation to pay workers' compensation or to satisfy a tort liability, economic performance occurs only as you make an actual payment to the person to whom you owe that debt. This basically puts you on the cash method for workers' compensation and tort liabilities. The IRS has issued regulations providing a lot of additional detail and nuances to these statutory rules, as well as specifying how those rules apply to a lot of other specific types of costs. But this is the basic framework. For today's purposes, this is enough to get you started in understanding the big picture of the economic performance rules. The other thing to be aware of is something referred to as the recurring item exception. What's a good tax rule without at least one complicated exception? The recurring item exception says that if you have a liability that otherwise meets the two-pronged all events test, you can treat the liability as meeting the economic performance requirement even if it doesn't really, if a number of specific conditions are satisfied. We won't get into those details today, but be aware that anytime you're considering whether you can take a deduction for a liability on this year's return, but it doesn't look like the economic performance requirement has been satisfied yet, you want to consider whether the recurring item exception might help you out. If it does, remember it's a method of accounting and you cannot use it without first getting IRS consent. One important point before we wrap up our introductory discussion of the economic performance rules. I've been speaking pretty informally about how these rules apply to expenses and whether they allow you to take a deduction on this year's return. To be more precise, though, you have to satisfy the economic performance rules as well as the two-pronged all events test before you can take any liability into account for any purpose under the tax code, not just for deducting current expenses. This includes adding the liability to the tax basis of something you're buying and that you want to start depreciating. That's a really important point to keep in mind. Economic performance has ramifications other than just deducting ordinary operating expenses on this year's tax return. In thinking about the business terms of a proposed deal, tax wrinkles like this can make a material difference to the buyer and the seller. Well, that's it for today's episode of Fed Tax 101. Keep checking back for more. So long, everyone.